Let's begin. Right. There will be some attendant bonuses for those that manage to stay awake, because for some reason people tend to fall asleep during my presentations. So in order to sweeten the pills and get your attention, what I will do is I will offer you an awarded paper I wrote in 2022 called MACTV Volatility Normalized Momentum. That paper was a huge innovation on momentum, and especially an improvement on the MACTV. And I wrote a paper about, actually discovered the indicator itself around 2015. So, and I submitted the paper in 2022 to the National Association of Active Investment Managers, and also to the CMT Association, the largest technical analysis association globally, because they host research competitions and awards. And I won the Founders Award for the National Association of Active Investment Managers, and the Charles Dow Award from the CMTA for this paper. So if anyone manages to stay awake during the presentation, I will send them that paper. Also, I'm happy to say that the indicator itself has been embraced by the professional community, especially providers of technical analysis software. So it has been embraced. It's already in stock charts. Very, very soon will be in TradingView, Metastock, MT4, Optima, and other platforms as well. So I will be able to send you that as well. And moreover, I will be doing some active momentum models, the advanced version of this awarded paper and the advanced indicator. So all you have to do is stay awake and send me an email to express your interest. Obviously, I will not be spamming you. Just send me an email to my personal email, and I will make sure you get all of these. So without further ado, right, this is a very generalized business cycle sine curve that has two basic sections: economic contraction and economic expansion. Then it is subdivided in three sections each. And what we will be doing today, we will be taking this conceptual framework, this six-stage intermarket cycle model, and provided some rules-based rules-based definition. How we can know when we are in economic contraction, when we are in economic expansion, based on the six main asset classes. This pioneering work by a good friend, Martin Prink. I've managed to improve it quite a bit over the years, but today we will be going at an introductory level, which is the Martin's work. So, where are we? Big picture. First of all, I would like to show you my approach so you know where I'm coming from, which is a multiple time frame, multiple factor approach. And why is it called this? Well, let's just firstly say that I'm a futures trader. I trade all global asset classes from FX, commodities, bonds, and equity indices. And I'm a semi-systematic trader, which means part of my methodology are fully systematic, others are a bit more discretionary, but everything is rules-based. But my analytical approach is what I call multiple time frame, multiple factor. So let me show you what exactly this means. So if you've got four stages, first of all, I've got, for example, and the monthly time frame, and I'm saying this before explaining this pyramid, the multiple time frame, the M.T.M.F framework. It's my hardcore belief that each time frame has its own return drivers. And when I say it's time frame, I'm talking about the monthly, the weekly, and the daily time frame. Each one has its own return drivers. Different factors affect the monthly time frame, difference the weekly, and difference the daily. So that's why I call it multiple time frame, multiple factors. So on the monthly chart, I think the most important factor is the business cycle, and of course economic statistics, sort of like anything that has to do with employment, production, inflation, and so on and so forth. Like hundreds, you can economic statistics you can find. So I think these are factors that influence the monthly, the big trends. Then I'm check into the weekly trend. And then I look at other macro factors. So for example, the commitment of traders, ports, seasonals, cycles, intermarket analysis, sentiment, and so on and so forth. Then I go to the daily chart, which is my operating time frame, because all my trades, although I'm a futures trader, and I do actually 3 types of strategies: short term, meaning holding from 1 to 5 bars, usually a week. I also have position trading. This may last probably anything more than that, probably 2 or 3 weeks. And then I've got investing, which is probably in these last weeks. These usually are done on ETFs, not futures. So on the daily time frame, that's where I do my technicals. So the last thing I look at is the technical. So I always start from a macro background and then go into the technicals. And then finally, that's the execution, obviously on the daily time frame. And for this, I use what I call the 5S framework. So let's look at this a bit more detail. This is what I call the one of the systems of the smart trader systems. It's a learning path, also chart checklist, if you will. So if you look at it in a roadmap fashion, so we can be looking at this on a step-by-step basis. The first thing I look at the business cycle stages, and this is something that we'll be discussing a bit today. Then I look at the intermarket cycle stages. This is what we're examining more in depth today. Obviously, my framework for this is a bit different than what we'll be presenting, because this presentation is supposed to be an introduction. Then I go to the commitment of traders report, the positions of the open, when I started through the study of open interest, the positions of banks, hedge funds, or commercial traders who, big firms who have a business interest in the commodity and futures markets, futures and options markets. Then I look at cycle seasonality, and finally I look at market sentiment. So this is my macro background: business cycle monthly, the rest of the 4 factors on the weekly chart. And once I have a green light on these, it doesn't necessarily have to be all 5 lining up. Then I go to the technicals, and the technicals, I look at the trend life cycle roadmap. Then I go into relative ranker, which basically the markets after got them in the first 8-stage framework, rules-based framework to examine the trend. Then I look at I rank them vertically from strongest to weakest. Then I look at the momentum speedometer, the momentum basically, which is the MACD momentum. This is the work I got awarded for. Then I look at volatility evaluation. I've done already webinars on FX Street for both volatility and momentum. So please feel free to check these on the YouTube channel, the FX Street YouTube channel. And then I look at swing structure, something that I have not disclosed publicly yet. All right, so what is the 5S framework, which we talked just in the previous slide for trading? 5S framework is how I structure a trade. First of all, I use the strategy, the selector. I select what type of strategy will be trading, will be mean reversion, will be breakouts, pullbacks. There are 7 different types of strategies that I use. So each one requires different factors to be at play: levels of momentum, levels of trend, levels of macro. Then I use setup. So that's the second S, the setup. The setup is basically my directional bias, whether I'm going to be long or short. And based on this basic combination of the previous factors, the technicals and the fundamentals. Then I've got the signals. The signal basically is what I physically get in. So once my setup is for a market to be, say, for example, long a market, then I start looking for buy signals. Having a setup to be long doesn't necessarily, entering right here, right now. I have to have a signal, which may or may not come. So once I've got my signal, I also place my stops in the market. I don't have mental stops. There are various stops, either stop loss or trailing stops. There are 4 different stops I use. And then I look at position sizing based on that. So this is my one of the systems I use for the smart trader systems. Okay, so as I mentioned, today we will be talking about the intermarket cycle. So let's go ahead. Why is this important to us? Why does this matter? Well, every day there is one question that most traders are asking themselves, whether they like it or not. And that question is, what will the market do? And of course, you may have different idea of what the market is. Some may be stock traders, some may be currency traders, other may be bonds, commodities. Everyone may say, okay, stocks are up, I'm looking at bonds going up. So they look at, so maybe look at markets in isolation, or they may look in conjunction with one other asset class, their favorite asset class. And someone may be a currency trader, say, say for example, dollar is up, stocks are down. And then someone will observe the following, that commodities are up, and so on and so forth. So there are various combinations that, or intermarket relationships and correlations that people check. But there is, most people, I would say probably 95%, do look at these asset classes in a rules-based framework to understand what the correlations are, what the markets are doing, and where we are in the business cycle, because that plays a big role. So the result is a lot of confusion, because people end up either looking at just one asset class, which I think is a big mistake, or they look at it, for example, with a relation with just one other. But there are many relationships which we must be examining at the same time. So that brings us to the need for a roadmap, an intermarket asset class roadmap. So how will we achieve that, have a roadmap for that? Right, so I will be beginning the presentation, and in general, that's my methodology for creating this sort of stuff, is create a foundational framework, something that, a conceptual framework, and then go into create a rules-based system. Try to flesh out what we saw before, the foundational framework, with a rules-based system. Rules to flesh it out, to take it from theoretical into more practical. Because I really like having systems, either they're going to be applied on a discretionary basis or on a systematic basis. I think everyone should be rules-based. And the result of being rules-based is, of course, is to, it's the bridge between ambition and goals. That's the discipline. If you want to be disciplined, you can only be with a rules-based framework. And of course, another benefit is that you get away from the confusion of forecasting. Oh, what will the market do? To the clarity of nowcasting. And nowcasting means that you don't need to examine what the market will be doing tomorrow. You don't need to be guessing what the market will be doing tomorrow, but you are only identifying what is doing today, because based on the research you have done, what is doing today, but when it fulfills an XYZ number of conditions, then you've got a statistical probability of having a directional bias, an edge, if you will. So let's build our foundational framework. First of all, okay, this is the foundational framework. This is what the economy looks like. It's a neat little graph. So in the middle, obviously, you've got four participants, the resource markets. Then you've got individuals. Then you've got businesses, and then you've got the product market. And in the government sits between all of these, and you can see the flows of from the businesses to the government. It might be taxes and subsidies and public goods. You might be from the product market to the businesses. Obviously, this is revenue from the business, from the businesses. Then you go to a rotation from the business to the research markets, where they have to buy products, raw materials to create products and services. And of course, the resource market is income for the individuals, and spending when they go to the product market, and so on and so forth. So this is by and large how, very oversimplified, look how the economy works. So the business cycle, if we look at it, any kind of measure of economic growth, the bottom sine wave, it can be GDP or any other measure of economic growth. You go through peaks and troughs, And you've got rising prices and falling prices as well. We usually went through a bout of inflation. And then on top, you've got the three main asset classes: bonds, stocks, and commodities. So how do these relate to each other? So this is the Brink-Turner 6 business cycle model. So what we will be presenting today is the framework, and then we're putting rules around it. And I think it's a quite useful model to know. And of course, it can be considerably improved. So let's begin with the framework, the conceptual, because it's best to understand rather than just give you the rules. So let's begin at the first part of the economic cycle. At the first part economic cycle, when economic activity is falling, and you can see that we are in a recession. The ISM index here, we'll use them as a measure of economic activity, the ISM index, which is below 50, growth is below average, employment is, again, we see lower wage growth, consumer expectations are falling, inflation is falling, and usually at this stage is the Fed usually has its first cut to try to revive the economy. The second stage, again, when the ISM index is also below 50, we started trying to see we are now deep into recession. Growth again is below average. The labor market is quite uncertain about the future prospects of the economy. Consumers are very, very reluctant to start spending. And inflation is falling because, of course, there is little demand. Rates are falling. The Fed, is cutting rates, although not as aggressively, again, to try to revive the economy. This is the lowest point of the economy, but at this point, stocks are starting rising. And the reason that stocks are rising is because, as we all know, stocks are a forward discounting mechanism. And from studies, it's been found that they usually discount about 6 to 9 months ahead. So during the lowest part of the economic cycle, stocks are looking forward to the better days that are ahead. So the next stage is where the economic activity has started picking up slowly because of the Fed trying to ease the rates and being more accommodative and providing liquidity to the system. Growth now has increased a bit. It's still a bit below average or approaching average. We start seeing some wage growth. Again, the economic activity also has effect on consumer expectations. Inflation, we start slowly seeing some rise because there is demand, and the Fed by now has understood that has revived the economy enough, so they've stopped cutting rates. So at this stage, because there is demand for goods, and obviously, there is the businesses are trying to accommodate that demand for products and services, commodities start going up. Now, then we've got the fourth stage when the again, economic activity is rising, is above 50. Now we're in economic expansion. We've got economic contraction and expansion. This is the expansionary part. The growth now, again, is above average. Businesses are very, very busy, aggressive buying materials, higher employment, consumer expectations are increasing, slow rise into the inflation. It's actually rising probably a bit quicker than it is before. And people are started talking about possibly hikes in the future. So because of that, of the higher inflation and the possible future rate hikes, bonds start falling. Then what happens? Of course, it implies that stocks and commodities are still rising. So the fifth stage, what now? So economic activity is rampant. It's probably the best stage of the business cycle. We see that the highest economic growth rate, production increases to keep up with sales, consumer expectations are usually at the highest level of optimism, Inflation is at the highest level, one of the highest levels, and by now probably hikes have stopped to curb inflation. So what happens here? Stocks start falling. So this is the part where stocks are falling. Again, a discounting mechanism, saying that the Fed will try to slow down things a bit in order to control inflation, to hinder a bit of economic growth. Stocks discount that and start falling. So what is the last stage? So obviously it goes to say that at stage 5, stocks are falling, bonds are falling, but commodities are rising. What we're trying to show here is the main asset class that it says it's at the turning point. So at the last point, what we have is the economic growth again is above average, but now it's falling. Growth is slowing down. We start seeing some rising inventories, slowdown in sales, a bit of rising unemployment. Again, a bit, the consumer confidence starts declining. Inflation is high, still high, and the Fed continues hiking in this environment. So what we see here now, this time it is time for commodities to start falling. So at this stage, stage 6 is the most bearish one, because what we have is both bonds and stocks and commodities falling. While in the third stage, we had both commodities and stocks and bonds falling. So this is the idealized business frameworks for us to understand. But can we turn this into a systematic, a rules-based system? Yes, and through the help of Martin, he managed to do this. And this is how the business cycle was the framework that was Martin's work. Now, before continuing, Martin's original work was on the monthly charts, and he used monthly charts, and he used, if my memory serves, the 10-week moving average, sorry, the 10-month moving average. Now, I took a bit of liberty and took that into the weekly chart. And what I did is use that as the weekly time frame. That's the first change, but I've done even more important changes. Again, they are beyond the scope of this presentation. So if you look it up, Martin's work, you find he did it monthly. Okay, so again, let's make it to a rules-based framework. You've got treasuries, S&P 500, and the Reuters Commodity Index, which represent bonds, equities, and commodities. So first stage, as we mentioned, bonds go up, which means commodities are down and stocks are down. So what is the first stage? How do we flesh it out? Right, we will be using the 50-week exponential moving average, and our definition of bonds being up is treasury bonds being above the 50-week moving average, which means stage 1 is bonds above the 50-day moving average, 50-week moving average. The S&P 500 is below its 50-day weekly moving average, and the Reuters Commodity Index is below its 50 exponential weekly moving average. So stage 2, stocks go up, bonds are already up, and then commodities have not started their ascent. So this is how it looks like. Treasury bonds above the 50-week moving average, S&P now turns above its 50-weekly moving average, and the Reuters Commodity Index is below a 50-week average. Now, stage 3, which is where basically all asset classes are bullish. Again, commodities are up, stocks are up, bonds are up. So this is the configuration, as you can probably easily guess, everything is above its 50-week moving average. So stage 4, when bonds start falling, the treasury bonds are below their 50-week moving average. The S&P 500 is still above its 50-week moving average, because at this point stocks have not been still, they discounted there is still some room for growth in the future. They're not as interested in, as inflation sensitive as bonds. And of course, commodities are still going up. So you've got the fifth stage. Now that stocks are start discounting economic difficulties in the future. Bonds are already in a downtrend, but commodities are still up. So again, so this is depicted by the bonds and treasury bonds, 10-year notes, and S&P 500 being below the 200-day, below the 50-week moving average, and commodities above their 50. And the last one is the commodities, where everything is bearish. Now that we have, so everything is basically below its 50-week moving average. And now that we have everything in a rules-based framework, how does this translate if we, does it get validated? Do we, is it just a theory, or do the numbers add up? So let's check out the numbers. So treasury bonds during stage 1 yield an average 1.8% annualized. The S&P 500 has an 18.5% annualized loss. The Reuters Commodity Index has an annualized loss of 8.2%. During stage 2, when stocks go up, now they, and of course bonds are picking up some steam, so they've got an annualized return of 4.8%. The S&P 500, 8.9%, and the Reuters Commodity Index is minus 12.5%. So you can, now for the third stage, now bonds are at probably at the last point of ascent. They've got an annualized rate of return of 2.1%. The S&P 500, 15%. That's the best return, the best stage for the S&P 500. It's one of the settings where you must have the most aggressive exposure to the markets. And the Reuters Commodity Index is 7.7%. And again, if you can see the numbers, the actual numbers do match the theory, and you can see that this is a great way on your to provide a fundamental filter, as we saw in the first part of the presentation, a causation as well to your trading. And as I mentioned before, I have it on the weekly chart because my operating time frame is the daily chart. So that's why I took it one time frame down, because using weekly charts, I can apply it on the daily. So that's why I gave it to you on the weekly chart. Of course, like I mentioned, I have a more advanced version of this, but for here now, I think as an introduction, rather than taking you to deep water, you can keep this framework, and I think it's extremely useful. And also gives you a deeper insight into why markets move, rather than just be a technical analyst. And I'm not saying in a derogatory way, because myself, of course, at heart, I'm a technician. If I was stranded on an island and someone put a gun to my head and said you lose one thing, I said probably I would use the MACD, and because I can use it both for trend and momentum. So the two factors I would use, trend and momentum. But luckily, since no one will be putting a gun to my head, I can also include fundamentals to increase the accuracy of my technical tools, because technicals answer the question when. Fundamentals answer the question why. And when you put a why behind your when, then your timing becomes much better. So let's see a few examples. This is stage 3 and stage 4. Depicted on the S&P 500, and as you can see on the highlighted bar, stage 3 and stage 4, it does provide you with a bullish headwind. So imagine if, for example, if you use this as a setup tool and said, okay, start looking for buy signals. When you're in a stage 3 or a stage 4, you can see that for the most part, in this particular period from 2004 to 2006-7, the S&P 500, whenever it was in stage 3, stage 4, provided much better returns. Then you can fast forward 2006 to 2009. Again, you could have the better part of the bull market, and you would avoid the bear market. Again, Of course, you can supplement this with technical tools, but the intermarkets will be giving you a very good causation and, of course, reasons to be taking a trade. It's not just because, someone threw a trend line or, there's some kind of a, Fibonacci number or a candlestick pattern and so on and so forth. Again, you can go fast forward. You can see this from 2008 to 2012. Again, when the market had stabilized, then stages 3 and 4, you can see that again, it was giving a green light to start taking buy signals. Now, let me focus a bit on the chart. As you can see, the market bottomed out in 2009, and a lot of people will be looking to buy tops and bottoms, like buying, February, late February, beginning of March in 2009, and then try to hold as much as possible. In real life, that does not happen. In real life, that does not happen. In order for you to avoid bear markets, whether it's in equities or even if you want to be trading a currency and you want to be avoiding declines, you have to give up something in order to take something. In order to take the safety of avoiding a decline, you have to give up a bit of the bull market as well. And I see this because a lot of people make the mistake of benchmarking their portfolio with the performance of a market which is a bit, pick and choose it. So for example, it's a bull market, so I want to be outperforming the S&P 500. When it is declining, obviously they don't want to be in equities or any other market, but you can't have it both ways. Now, so if you want to be achieving outperformance, you have to see the whole of the cycle, which the whole of the cycle means one bear market plus one bull market. So if you have one complete cycle, yes, outperforming the market theoretically can be done, but it's very difficult to have outperformance during an uptrend and then say I want to be also out of the downtrend as well. That doesn't happen, at least not to my knowledge, and from the other hundreds of professionals and I have spoken to, you can't. I mean, it's not doable, but you can have great performance when you have it on a complete basis, both bulls and bears. And you usually do. You try to avoid, like say, 80% of the bear and have, say, 50 or 60% of the bull. So in combination, these two create a much better return. So again, fast forwarding 2009, 2013, yet again, you can see, as I mentioned, this is just one tool that one can use. You can also use the commitment of traders report, sentiment, but the main thing, the main thing I want to impart upon you is to combine technicals and fundamentals. Firstly, multiple time frames, multiple factors, and then secondly, do it on a systematic basis or rules-based basis. And again, fast forwarding from 2016, 2019, we saw them, you can see the highlighted bars. As I mentioned, we've seen from it started, I think, member serves 2006, and now we ended up in 2019. So I've seen probably 13 years of history just through these charts. And also 2020 all the way up until late 2022. Probably we've seen around a bit like 1.5 decades. As you can see, the theory works. So where to from here? Where to from here? Like I mentioned, in 2022, I wrote a paper called M.T.M.F, Volatility Normalized Momentum. And this is my bonus for those that managed to stay awake. And it was a huge improvement over the classic MACD for those that use momentum again. And from what I understand, there was one study in Bloomberg even among institutional investors, and they found that the MACD is the second most popular indicator. So the MACD is a considerable improvement upon that. I think the most popular was the RSI, but it improves both the shortcomings of the RSI and the MACD. So again, this was awarded twice. So what I'll be doing as a gift, show you the papers, and this is the advanced version of the MACD. What I have done, I've taken it a step further, creating signal generating mechanisms. Basically, to give you a bit of a hint, I'm no longer using the signal line of the MACD, for those that know what the MACD, how it works. And so I managed to create something a bit more faster. And so the attendance bonuses, as a reminder, the paper, the indicators, it's already available in stock charts, and very soon it will be put on TradingView, Metastock, MT4, Optima. I can also give you the code for other platforms, for example, like Bloomberg, Thinkorswim, and so on and so forth. And also we'll be having the MACD momentum model. Again, all you have to do is send me an email. And with that, I would like to thank you very much for the opportunity to present. If there are any more questions, I will be more than happy to answer these. I hope you were intrigued, at least, at the very least, or motivated to study a bit of intermarket analysis, study a bit of put some causation behind your trades, and especially present for you the multiple time frame, multiple factor approach. And I hope you put it to some practice. If you need more information to because this is information to then switch to implementation, feel free to send me an email. I can send you more details. And with that, I would like to thank you all very much. You've been a wonderful audience, and I hope to be seeing you again in one of these fantastic webinars organized by FX Street, which really does an excellent job of putting quality content to the trading community. Thank you all very much, and I hope I'll be seeing you again probably next week at the next FX Street webinar.